All right, let's talk about trading. Today, we're going to flip the script and show you how to transform trading from what feels like a total gamble into a disciplined science. We're going to walk through a super clear 7-step process for building your very own trading model. Let's dive in. You know the feeling, right? We have all been there. You're staring at the screen. Your heart's pounding. That fear of missing out, FOMO, it pushes you to buy when things are peaking. And then panic sets in on a downturn, and you sell at the bottom. It's this gut-wrenching roller coaster of greed and fear that, let's be honest, often leads to our biggest mistakes. And that's the core of the problem. When you trade on a hunch, you're essentially gambling. It's a recipe for inconsistent results and, frankly, a ton of stress. But what if? What if there was a way to take all of that emotion out of the equation? Well, that's where the trading model comes in. Seriously, think of it like a recipe for your investments. It's not about what you feel might happen. It's a systematic, rule-based framework that tells you exactly when to buy and exactly when to sell. It's your blueprint for navigating the markets with cold, hard logic.
So why is this so powerful? Well, it comes down to 3 huge things. First, it's like an emotional circuit breaker. The rules make good decisions, not you. Second, you can actually test it. You can run your model on years of historical data to see if it even would have worked before you risk a single penny. And third, you can automate the whole thing, freeing you from being glued to your screen all day.
Okay, so you're sold. How do you actually build one of these things? We can break it down into 3 main phases. We'll start with the first one, crafting your blueprint. This is the creative part, the analytical foundation for your entire strategy. These first 3 steps, this is where the magic really happens. You start with an idea, you test that idea against real data to see if it has any legs, and then you refine it. Conceptualize, identify, and develop. Let's break each one down. Step 1, conceptualize. Every great model starts with a simple hypothesis. It could be a pattern you think you've noticed. For our example today, let's use a classic trend reversal idea. When a stock takes a hit and drops by, say, 3%, it's likely to bounce back and gain 4%. Simple enough, right? But an idea is just an idea until you can prove it with data. And that brings us to step 2, identifying opportunities through something called backtesting. This is where you become a bit of a data detective, digging through historical records to see if your theory actually holds up in the real world. So here we can see the model in action with some sample data. Okay, look at February 4th. The stock dropped 3.5%. Bam, that meets our rule. The very next day, it shot up almost 4.6%. That's a perfect win. But then look at February 7th. It dropped over 3% again. But the next day, it only recovered about 2%, falling short of our 4% goal. This chart really visualizes those early results. 1 clear success and 1 failure. And here's the key takeaway. Your first test is almost never going to be perfect. And you know what? That's totally okay, because those imperfections lead us directly to the next critical step. Step 3 is all about fine-tuning. This is where you get to ask the smart questions. Does our 3% dip rule work better on a Monday? Or maybe it only really works for highly volatile stocks. You start tweaking the parameters, adjusting the recipe, and then you test it again and again, all to try and increase your success rate. Okay, so you've tinkered and tweaked, and now you have a model that looks fantastic on paper. Now it's time for a big old dose of reality. This next phase is all about making sure your theoretical strategy can actually survive out in the wild. Let's say your backtesting shows that for every 10 trades you make, you get 7 wins of $2 each and 3 losses of $1. That gives you a theoretical profit of a very handsome $11. Looks like you've built a winning machine, right? Well, not so fast. Theory is one thing. Reality is a whole different beast. Before you get too excited, you have to ask a really important question. What's actually left after all the real-world costs and limitations get factored in? This is step 4, the practicality study. Your theoretical profit doesn't account for real-world friction like brokerage fees. For example, what if your fee is $2.50 per trade? Suddenly, that $11 profit just vanished into thin air. You also have to think about capital limits. Can you even afford to make all the trades your model suggests? So after that tough practicality study, you get to step 5. Which is the big decision point. It's a fork in the road. You either have a model that's robust enough to go live with real money, or you've found some fatal flaws, and it's time to head back to the drawing board. No shame in that. Now for the final phase. Let's say your model passed all the tests, you've gone live. The work isn't over. In fact, in a way, it's just beginning. This whole part is about long-term survival and staying sharp. You have to remember the market is a living, breathing thing. It's constantly evolving. A strategy that worked perfectly last year might completely fall apart this year because of new economic conditions or global events. No model is ever set and forget. And this brings us to our final 2 steps, which are absolutely essential for the long game. Step 6, prepare for failures, because I promise you, they will happen. And step 7, incorporate risk management. You must have rules for when things go south, like if you buy a stock after a 3% dip and it just keeps on dipping, at what point do you cut your losses and get out? Having that exit plan is completely non-negotiable. And this quote from our source material really just says it all. The ultimate discipline here is emotional detachment. You can't fall in love with your model. If the data shows it's failing, you have to be ruthless enough to dump it and move on. That is the absolute key to long-term success. So we've walked through all 7 steps, from a simple idea all the way to a disciplined, real-world strategy. The real power here is making that shift from emotional guesswork to a logical, testable process. Which leaves me with one last question for you. Thinking about your own observations of the market, what's the very first rule you would write down?